All righty. Good morning, everybody. Thank you for hopping on for this month's Industry Hour. This month we have Peter Willis with Stacey, Braun Associates, and he's going to give an update on the state of financial markets right now. You do all have the ability to unmute yourselves. I would ask if you're going to ask a question, just hold off till the end or use the chat feature and I can ask Peter if the question is urgent. This webinar is being recorded and will be placed on the chapter's website. So if you wanted to share with any of your other employees, please feel free to do so. With that, I'm going to turn it over to Peter. Thank you.
All right, good morning, everyone. So the conversation we're going to have today is about the financial markets, which is certainly not going to be an upbeat presentation. It's just really a terrible year for stocks and bonds, and I hope to go over why that's happening and what we should do about it. So I guess to sum it up, the state of the financial markets in one word is lousy. So I'll share my screen here and let's see. Okay. So why don't I start with a little bit about who is Stacey, Braun Associates. I understand we're not a household name, but we are one of the largest 300 money managers in the world. We're located up in New York City, right on Broadway. We've been around since 1977. We did manage about 4.7 billion. That's gone down a little bit this year. 96% of our monies under management is asset management. And then we have a financial planning division, which is about 4%. We manage money for employee benefit funds. We manage the chapter's money and the employees that work for you guys. We're 100% employee owned. As far as who am I? I've been with Stacey Braun for 31 years. And when you hang around that long, that's why they make you president. You just outlast everyone. That's the secret. Before that, I was with a bank that was merged into Wells Fargo, and I was managing stock and bond mutual funds for them a long, long time ago. So let's get right down to it. What I'm going to kind of try and get across here is just how bad this year is. Everyone remembers 2008, and that's when it looked like the world was falling apart. You had Lehman going under, you had Bear Stearns going under, you had AIG and Fannie Mac and Freddie Mac being taken over by the government. And everybody remembers that as kind of it actually was the second worst recession the country had ever had. The first being, of course, 1929 and the Great Depression. But for investments, this year, 2008, is probably worse. And let's take a look at the stats. These are the numbers from back in 2008. And everybody remembers, stocks being just dreadful. S&P was down 37%. NASDAQ was down 39%. But there were a few places where you could hide out back then. Bonds, as long as they were high quality, actually didn't do too badly. You can see investment grade corporate bonds were only down 3%. US government bonds were actually up 12%. Junk bonds were down 26%. So again, as you can see, as long as you stayed in the high quality stuff, you came out all right. And then I just threw down some other asset classes. Gold did okay that year. REITs, which is real estate, obviously got beat up in 08. That's what caused the whole problem, of course, was the mortgage fiasco. But the bottom line here is that you could hide out in government bonds. And what a lot of people did is they sold stocks and they bought government bonds. And actually came through it, made a little bit of money. Now let's take a look at this year. And these are numbers through September. So we're looking at the first 9 months. Unfortunately, things have not really improved much. The S&P this year is down about 24%. So a little better than in 08. Growth stocks are getting hit hard. They're down 31%. Value, everyone's talking about, oh, you can hide out in value. Value is the place to be this year. Well, you're still down 18%. And value stocks have underperformed the market for about 20, 25 years. So considering how badly they've done, to be down 18%, I would argue is nothing great. International is down even more than the US, down 27%. So you can see there's nowhere to hide in stocks this year, whether you're growth, value, international, it's all down. But here's where the big difference is and where the real damage is. Let's take a look at bonds. And when you think about it, bonds are supposed to be the backbone of your portfolio. You know, you buy some bonds and they do okay. You know, they don't go down in bad times. They insulate your portfolio. But look what's gone on with bonds this year. The aggregate bond index, which is kind of the S&P for bonds, is down 15%. Corporate bonds down 19%. Treasury bonds down 13%. Junk bonds down 15%. So in 08, as you saw, you were up 12% in treasuries. This year, you're down 13%. And that's the big difference here, is that you cannot hide out in bonds. And again, I put down some other asset classes. REITs this year are getting killed again, down 28%. And this is really strange. Gold. You know, gold is supposed to be the thing that you buy and does well when the world is collapsing. So, you know, now you have oil prices shooting up. You got wars going on in Europe. You got uncertainty with China and Taiwan, and gold is down almost 10%. Makes no sense at all. And then Bitcoin, which of course didn't exist in 08, is down 60%. So, you know, once again, this year, there's just nowhere to hide. And it's really ugly. So let's get into why is this happening? And I'll start with bonds. And I should point out, this is the worst year ever for bonds. It's not the worst year in 10 or 20 or 30 years, literally ever. I read some article about Germany back in 1780 had a worst year, but I wouldn't. This is bad. So what's going on with bonds? Well, interest rates are rising, and you can see the federal funds rate. That's the rate that the Federal Reserve controls. That's overnight money. That was at 0 when the year started. Well, as of 10/24 is at 3.25. The Fed raised rates last week, so it's now at 4%. So the Fed has risen the rates that they control from 0 to 4%. A 2-year Treasury started the year at 0.7. It's now 4.5%. 10-year Treasury was a 1.5. It's now 4.2%. And kind of how does this relate to everyday life? Well, a 30-year mortgage started the year at 3.4%. Today, it's almost 7.5%. That's the highest rate for a mortgage since 2007. So interest rates are going up. And in our opinion, basically 2 reasons this is happening. And the biggest and most important is inflation. Inflation's running about 8.5%, depending on how you measure it. And when you think about it, when you buy a bond, you're giving someone a loan. So let's say you buy a 10-year US government bond. You're basically giving the US government a loan for 10 years. They give you some interest over that time period. And at the end, they hopefully give you your money back. If inflation is going up, that means the money you get back in 10 years is worth less. So that's why inflation hurts the value of bonds. Now, bonds have done well. They've been really on about a 40-year bull market because interest rates have basically fallen since the 80s. Inflation, as you remember, in the 70s and early 80s, inflation was 15, 16%, and it's been coming down ever since. So bonds have been a decent investment over the last 40, 50 years. This year, it's completely reversed. You have inflation skyrocketing, you have bonds cratering. Second reason bonds are down is because the Federal Reserve is increasing interest rates. And as you can see up above, they went from 0 to 4%. Why is the Federal Reserve doing this? They're hoping to slow the economy down. They think if they slow the economy down, that'll take the pressure off of inflation. And if you think about it, if unemployment goes up, that means workers have less, ability to get a raise. People will just take any job. They won't be looking for, a large pay increase. There'll be, less people taking vacations. So, airlines and cruise rates come down. Less people buying homes, home prices come down. So the Federal Reserve is attempting to raise the cost of money so that the economy slows down. So credit card rates will go up, mortgage rates will go up, business loans go up, car loans go up, and they're hoping that slows the economy and slows inflation. So as I was saying before, bonds are supposed to be the backbone of your portfolio. They're supposed to be the slow and steady, if you will. This is just a chart going back to 1998 showing the return of bonds. And you can see they average about 5% a year. And then look at this year when you're down 17%. I mean, there's literally never been anything like it. And again, that just shows this is really unprecedented. So that takes care of why bonds are down. Why are stocks down? We feel they're down for three reasons. And again, the most important by far is higher inflation. Inflation is bad for stocks because it's bad for corporate earnings. When inflation goes up, labor costs go up, material costs go up, transportation, borrowing costs go up. That eats into companies' profits, eats into their profit margins, and obviously lower profits mean lower stock prices. So inflation is definitely not good for the stock market as well. It also raises, when you think of young companies that are borrowing money to grow, it costs them more money to borrow. Second reason that stocks are down, in our opinion, is China has this absolutely ridiculous COVID policy. They call it zero tolerance. Why does China matter? Well, they're the second largest economy in the world now, so they matter a lot. And what's happening in China is they are too stubborn to use our vaccines or Europe's vaccines. So they're using their own, and their own vaccines aren't very good. So what they're doing is they're locking down cities if there's a few cases of COVID. So the other day, there was a city a little smaller than New York that had 60 cases of COVID, and they shut the whole city down. And when they shut a city down in China, it's not like here. You're confined to your apartment or your home. You're not allowed to go out for any reason. And this is obviously screwing up supply chains. If you're a company trying to get parts or something out of China, it's really impossible. You may have read last week that Shanghai closed down Disney World over there because there was COVID. There was 9 cases and they shut the park down. I did read later on that they kept the rides open, so might not have been a bad thing if you were actually there. But so they have a very, very strict COVID policy, and it's causing the second largest economy in the world to slow down dramatically. Third reason is, of course, the Russian invasion of the Ukraine. This just, it doesn't affect the US that much, but this just increases uncertainty around the world. Is Putin going to use nukes? Is Putin going to go into another country? Obviously the price of oil and gas, especially for Europe, has skyrocketed. And it means that European economies are quickly slowing and probably headed to recession. So you've got the second largest economy in the world in China slowing. You've got the third largest economic bloc, Europe, also slowing, probably going to recession. And obviously that's not good, again, for corporate earnings, as the world is all tied together now. So what's gonna turn this around? How do the markets get better? And basically, in our opinion, you need good news on one of those three things. You need good news on inflation, on China, or on Russia, or what would really be nice is good news on a few of those things. The war in Russia, in our opinion, isn't probably going to get any better anytime soon. It looks like a mess over there. China, nobody ever really knows what's going on over there, but there might be a chance that things are getting better there. Their President Xi was just appointed for another 5-year term. So now that he's got that under his belt, he may feel like he can relax things more. There's a story on the front page of the Wall Street Journal today talking about China starting to relax things. So maybe some good news on that front. But what we're looking for is better inflation news. And there is starting to be some signs that inflation may be peaking. And I just put down some commodities here. These are the decrease from their peak, and most of these things peaked back in May and early June. But oil's down 30%, natural gas is down 30%, copper down 30%, freight rates down 67%. Used cars, you remember during the COVID, that was a big thing. Used cars were so expensive, they're coming down. Lumber is down 70%. The new iPhone 14, when they announced it last month or 2 months ago, no price increase. Of course, you can't get it. And then Tesla just a couple of weeks ago cut the price of cars in China by 9%. So maybe some early signs here that inflation is peaking. The two biggest pieces of inflation, though, are wages and rents, or rents in real estate. There's no real signs yet that those are coming down. Maybe some early things. I'll show a few charts in a moment. But those are what we really need to start seeing some improvement in. So it's a little too soon to tell. So maybe, commodity prices are coming down. Maybe this shows inflation is peaking. As I said before, you have European and Chinese economies slowing. You also have some of the supply chain disruptions dissipating. You remember during COVID, the big stat you'd see every week was how many ships were off of Long Beach, California. I think it was 150 at the high. I saw the other day there was 2 ships out in the Pacific waiting to come in. So that's a sign that people are getting back to work and they're starting to get rid of some of these bottlenecks that would help inflation, obviously. I commute from New Jersey to New York City every day. I can tell you in 31 years, I have never had traffic like I'm experiencing now. So clearly people are going back to work. I just wish more of them would be taking the train. So maybe some early signs of inflation dissipating here. Couple charts. This just shows it's a survey of wages, and you can see during COVID, look at that huge spike down, and then wages skyrocketing ever since there, but now starting to flip the other way. There's been recent layoff announcements by Lyft, Amazon, Facebook, Twitter, Goldman Sachs, Morgan Stanley. So there is some, again, early signs that maybe things are starting to slow. I know this sounds grim to be talking about unemployment being positive, but that's the way the markets work, and that's the way inflation is. This is a chart just showing some rents. Again, look at since the start of COVID, they just went straight up. I mean, just crazy, but starting to see some signs. I can tell you my daughter just graduated college and got an apartment in New York City. It's about the size of a shoebox. I've never seen a smaller place in my life, and the rent was just crazy. So I think we have some work to do there. This is just a chart showing occupied rental units, and you can see just crazy until just recently. And it looks like they're starting to be, again, maybe some green shoots here that rents are coming down. It obviously takes time for these things to work through the economy. The US economy is kind of like a aircraft carrier. Really hard to stop and start, really hard to turn. So things take time. And that's what the Fed is trying to do, slow things down, but it doesn't happen very quickly. Another, I know this doesn't sound like a positive, but there's a lot of damage that has already been done. This is from peak to trough. S&P this year is down 25%, NASDAQ down 35, Dow down 21, growth down 33, value down 19. So all these things are in bear markets. So a lot of damage has already been done. A lot of this bad news is hopefully in the markets. So as I've been saying, that what the Federal Reserve is attempting to do is slow down the economy to slow inflation. So they're increasing their interest rates to do that. They're hoping to, as I said before, slower economic growth will lead to lower inflation. So for a while here in the coming weeks and months, bad news or bad economic news is actually going to be good news for the markets. We actually want to see signs of slowing. So you want to see, as I said before, you want to kind of see unemployment going up. You want to see slower GDP growth. You want to see slower housing and retail sales. So bad economic news will actually be good news for the markets. On the flip side, if you see strong economic news, it's probably going to be bad news for the markets. And because if we keep getting signs that the economy is still doing well, that means the Federal Reserve has to keep raising interest rates. Now, a thing about the Federal Reserve, in my opinion, they haven't been very good in recent years. Jerome Powell, the head of the Fed, is kind of one of the main reasons we got into this mess. He kept money way too loose for way too long. He kept interest rates at basically zero for a few years when the economy was doing very well. And he's the one that created a lot of this fraud. The fear now is that he's going to keep things too tight for too long. Usually when the Federal Reserve is raising interest rates, they raise 25 basis points, they wait a few months, they raise 25 more, they wait a few months, they see what's happening. This guy is, raised 75, next month 75, next month 75. So he's really, instead of tapping the brakes, he's jamming on the brakes. So the worry now is that he's going to hit the brakes too hard and send us into recession. And that's certainly a fear. So why should you stick around? Why should you stay in the markets? Everything is at this point is gloom and doom. Do you take your money out and sit on the sidelines? Well, a couple things to keep in mind. Number one, you got to be right twice. You got to get out and then you got to get back in. Lots of people are really good at doing one of those things. You hear people have had whole careers on getting out at the right time, but then you got to figure out when to get back in. US markets, as I'll show in a moment, always come back in time. Every bear market we've ever had, if you hung in there, you get your money back in the next bull market. And then finally, with interest rates up, you can actually make some money in bonds now. Again, if you had bought a 10-year bond in the beginning of the year, you made 1% in interest. Today, you can buy a 2-year bond and make 4.7%. So you could hang out in a 2-year bond and make a little bit of money. So let's look at market timing. This is a chart. If you had invested $10,000 back in 1980, what it would be 40 years later. So 1980 to 2020. If you put $10,000 in the stock market, believe it or not, after 40 years, that would have grown to $708,000. If you missed the 5 best days during that 40 years, you only made $458,000. So instead of making 11% a year, you make 10% a year. If you missed the 10 best days, you only made $341,000. And if you missed the 30 best days, you only made $135,000 instead of $708. So you can see it's very, very difficult to time a market. Missing just 5 days cost you what, $250,000 or so. So you got to be really, really good. And anyone that's good enough to do that is, been sitting on a beach for a long, long time, I guess. And then this chart shows the yellow is bear markets, the blue is bull markets over the years. This goes back to 1958. And you can see every single time, if you just hang in there, you're going to make more than what you lost back. So again, staying in the market over the long term is definitely the way to go. It's always worked in the past. So let me end on a positive note. I know a lot of you guys are probably Philly fans. It's actually a very good thing that the Phillies did not win the World Series. Every time the Phillies have won, there's been a major recession in this country. You can see back in 1929, obviously the Great Depression. 1980 was a very bad recession, and in 2008, of course, the second worst recession ever. So we kind of dodged a bullet in that regard, as at least that's one worry we don't have to have. So to kind of wrap up here, obviously 2022 is just a really crummy year for all investments, stocks, bonds, gold, now real estate. Really no place to hide. But I would argue a lot of damage has been done. If you hang in there, you always make your money back. And what we're looking for is good news on one of those 3 fronts, especially on inflation. So we really need to see declining inflation. By the way, Thursday, we get the consumer price index at 8:30. That is going to be a major, major number. If that number shows a decrease, you'll see the market really take off on Thursday. If that shows an increase, you'll see some big damage on Thursday. So that's the state of the markets. The other option out there, I guess, is I heard on the way in, Powerball is up to 1.9 billion. I guess they didn't have from what I heard, they didn't have they didn't pull the number last night because there was so much money coming in. So that may be another alternative. Does anyone have any questions?
All right, thanks, Peter. Yeah, feel free to unmute yourself if you have a question. We'll leave this open for a couple minutes and see what comes in.
Peter, do you have an idea when the bottom is really the bottom? I know we're beating you up over this, and obviously with the Penn-Del, we partner with you, local people too, we partner with you, Stacey too, so you're a huge partner of ours, and you're not doing this. So what can we do to either stop it, or when can we tell some of our people that the bottom is here?
I think the markets will bottom before the economy bottoms. The markets are always looking 6 months ahead. So I'm hoping we put in the lows back in September. But I don't think it's going to be a straight line back up. And when you think about the last few bear markets we've had, they've been really quick. They've been like a week or a month or a couple months. This bear market looks a little more like a traditional bear market that lasts a year and a half. Now, we're almost at the end of this year will be almost a year, so it's getting hopefully a little long in the tooth. But the best case scenario would be we start to see the economy slow down, but not go in recession. That's what the Fed's trying to engineer, and it's really, really hard to do. But I'm hoping the lows were in September. I'm just not sure that it's going to be a quick snapback, though. We could just hang around, for a long time as we kind of sift through the damage. But the good news is, again, you can buy some bonds now and make some money. We've been buying. We put some money back to work in the short end of the bond market in 2 or 3 years. And again, a 2-year U.S. government bond at 4.7% isn't bad. That's risk-free. Even if rates keep going up, you can hold it to maturity and you'll get your money back. And also kind of takes the pressure off equities. The last few years, you had to be getting 15, 16% in equity to make your 7% assumptions, on these pension funds. That's what they're looking for, because you weren't getting any help from bonds. If you can get 4.5% out of the bond side, you don't need that much out of the stock side. So, the flip side, though, is if the Fed, and this is becoming a bigger and bigger damage, if the Fed keeps money too tight too long. Last week, when Powell was giving his press conference, he did say that they weren't going to lock in 75 basis points when they meet again in 6 weeks. So that's a good sign. At least he's taking that off the table. But I think it would be a good idea if they kind of took a step back and let these higher interest rates kind of work through the economy, because I think at some point they're really going to slow it. And so, again, I think so. To answer your questions, I'm hoping stocks bottomed in September, but I think the economy will continue to slow. We probably, let's get through this winter. If you have a harsh, cold winter, Europe is dead. I mean, they're in real trouble over there. They have no energy. Putin's cut off their gas. They shut down their coal. They shut down their nukes. So they really don't have anything other than liquefied natural gas coming from us. And so if you have a cold winter, even here, I think energy prices could spike back up, and that could really slow the economy down more than the Fed wants. So you got to hope for a mild winter.
All right. Any other questions for Peter? Hearing none, I just want to thank you again, Peter, for hopping on and all the work you do for the chapter and our funds. It's much appreciated. We did have a conversation before. We will be offering a similar presentation on this topic next year, and hopefully there's some better news on the economy then. With that being said, I'm going to send out an email with a survey. Please take it. It should be a few questions just on the results of this presentation. With that being said, I hope everybody has a great day and thank you for joining this meeting. Thank you.